Welcome back. In today's explainer, we're diving straight into a real financial mystery. We're looking at American Tower, a total powerhouse in the real estate and telecom infrastructure space. Now, if you've been keeping an eye on the markets, you know this stock has been on a seriously wild ride lately. And the data? Well, it's telling us two completely different stories. On one hand, we've got valuation metrics that look absolutely incredible, literally screaming buy. But on the other hand, there are some glaring red flags that are making Wall Street sweat. So let's just get right into it and see what the numbers are actually trying to tell us.
Is a 27% price drop a giant warning sign, or is this a rare buying opportunity? That's the million-dollar question we've got to answer today. Look, when a massive, historically dominant company takes a sudden nosedive, the market is usually trying to warn us. But the market isn't always right. Sometimes it totally overreacts, and that panic, it can create these incredible windows to buy wonderful businesses at a steep discount. So we need to look at this objectively. Are investors fleeing a sinking ship, or are they just leaving money on the table for us to scoop up? To really understand the panic, we have to look at the damage. Negative 27.18%. That's how far American Tower has fallen from its 52-week high. At its peak over the last year, you were paying over $234 a share. Today, it recently closed at just $170 and change. If you've been holding this stock over the last 12 months, well, it's been a tough pill to swallow, right? You're looking at a one-year trailing total return of practically negative 16.5%. And honestly, seeing that kind of momentum just evaporate is exactly what shakes the confidence of everyday investors.
Now, what's really interesting here is how the narrative totally flips when we zoom out. While this past year has been brutal, consider this long-term track record. Over a 20-year period, American Tower has delivered a staggering positive 597.99% return. We're talking about a compound annual growth rate of over 10% for 2 solid decades. This isn't some hyped-up tech startup. This is a proven long-term wealth compounder, and honestly, that just deepens the mystery for us. Why is a company with this kind of legendary track record suddenly being priced like it's going out of business?
Section 1. Calculating intrinsic value. When we start digging into the actual forensic accounting, the tension in the narrative hits you immediately. To figure out what the underlying business is actually worth, we use a discounted cash flow, or DCF model. This basically calculates the true intrinsic value of the company based on the actual cash it brings in the door. The current market price? About $170. But when you run the numbers on American Tower's free cash flow, the actual money the business generates after paying to keep the lights on and maintain its towers, the DCF fair value comes out to $217.18. So according to the cold hard cash flow, the stock is trading way beneath what the company is theoretically worth.
Which brings us to one of my all-time favorite investing concepts, the margin of safety. Basically, this is just a buffer zone between that intrinsic value we just calculated and the actual price you pay in the open market. Think of it as your insurance policy. If your growth estimates are maybe a little too optimistic, or if the market suddenly throws a tantrum, having a wide margin of safety protects your downside risk.
So the crucial point is that American Tower is currently offering a margin of safety of 21.43%. That means you're essentially buying the future cash flows of this massive infrastructure business at a roughly 21% discount to their calculated fair value. For a company that has crushed the market for 20 years, finding it trading at this kind of steep discount is our very first major clue. It really makes you think we might be staring at a super rare opportunity here rather than a trap.
Section 2. Decoding valuation multiples.
Okay, so we know that discounted cash flow looks great, but what about the relative valuation multiples? Are the metrics actually cheap across the board, or is that DCF model just a weird outlier? Well, when you compare today's multiples against American Tower's own 5-year historical averages, a pretty crazy pattern emerges. Right now, the price-to-earnings ratio is about 27.5. And yeah, in a vacuum, that might sound a little pricey, but actually, it is a massive 49% lower than its 5-year average. Then look at the price-to-free cash flow. It's sitting at 21.12, which is nearly 28% below its historical norm. And enterprise value to EBITDA, which is an awesome metric because it actually accounts for debt, is at 15.85. That's down 18% from the average. Across the board, you're paying roughly half the premium that investors were happily paying for this exact same business over the last 5 years.
And then there's the PEG ratio. If you're not familiar, the PEG ratio measures a stock's price to earnings against its actual earnings growth rate. The general rule of thumb here is that a peg under 1.0 suggests the stock is undervalued relative to how fast it's growing. Well, American Tower's PEG ratio is sitting at an insanely low 0.46. It is almost 88% lower than its 5-year average. When you pair that with their trailing 12-month earnings growth of over 76%, this tiny PEG ratio suggests the market is just totally ignoring the company's recent bottom-line explosion.
Section 3. The dividend income story.
Now, while we wait for the market to wake up and potentially close this valuation gap, we have to ask ourselves, are we getting paid to wait? Well, check out the health of their payout. American Tower is paying out 64.79% of their earnings as dividends, leaving about 35% as retained earnings. And this brilliantly illustrates exactly what you want to see in a mature infrastructure business. It proves the dividend is generous, but crucially, it's not eating up every single dollar they make. They still have a very healthy chunk of cash, over a third of their earnings, left over to reinvest in new towers, pay down debt, or just weather any economic storms.
When you break down the dividend highlights, the story gets extremely compelling. You're getting a really juicy 4.2% dividend yield right out of the gate at the current price. But honestly, more importantly, look at the consistency here. 15 consecutive yearly increases. Through the pandemic, through crazy rate hikes, through market crashes, they have hiked that payout every single year, for a decade and a half. Plus, it's growing at a very healthy 5-year compound annual growth rate of 7.6%. So you're not just getting a high yield today, you're getting a yield that's historically outpaced inflation.
Section 4. Profitability versus risk.
So what's the catch? We've established the stock is trading at a discount to intrinsic value, it's historically cheap based on its multiples, and it pays a massive, growing dividend. But let's be real, the market isn't stupid. If a giant stock drops 27% and trades at half its historical multiples, there is a reason for it. Every good deal in the market comes with a catch, right? A dark side to the story. So we need to flip over some rocks and figure out exactly what it is that has Wall Street so absolutely terrified of American Tower right now. Okay, let's dive into this, because the mystery really starts to unravel when we look at their leverage. The company boasts an absolutely eye-popping return on equity of 82.33%. That is incredibly profitable. It means management is generating massive returns on shareholder capital. But on the flip side, their debt-to-equity ratio is 10.59. That number is huge. It reveals extreme financial leverage. They are essentially funding that sky-high return on equity by carrying an absolute mountain of debt. And, in a world where interest rates have been rising rapidly, carrying this much debt makes investors incredibly nervous that future interest payments are going to just devour their profits.
And that risk? It's heavily compounded by their current ratio, which sits at a shockingly low 0.30. The current ratio basically measures a company's ability to pay off its short-term liabilities with its short-term liquid assets. A ratio of 0.30 means they literally only have 30 cents in liquid assets for every dollar of obligations they owe within the next year. To put that into perspective, this metric is currently sitting 42% below its own 5-year average. This severe lack of short-term liquidity, especially when combined with that massive long-term debt, is almost certainly the catch. This is exactly what is scaring the market away and acting like an anchor on the stock price.
So we finally arrive at the ultimate crossroads. On one hand, you have this proven, historical winner trading at a 21% discount to its cash flow, offering a safe, growing 4.2% dividend and priced at basically half its normal historical premium. On the other hand, you're staring down a highly leveraged balance sheet and razor-thin short-term liquidity, all during a pretty tough macroeconomic environment. Is the market right to be terrified, making this a classic value trap? Or is this just a super rare opportunity where the market is severely over-punishing a fundamentally sound business? The data is all laid out in front of you. Now it's up to you to decide how this story ends. Thanks for joining me on this explainer, and keep learning.